Howdy, Jacob here. Today we're looking at Oxford Industries in the textile, apparel, and luxury goods industry. 1.7 billion market cap with just under 1.8 billion in enterprise value. They were founded in 1942, so they've been around quite a bit. Looks like they design, source, market, and distribute products of lifestyle and other brands worldwide. Their products are its retail store, department store, multi-branded e-commerce, brand-specific full-price retail store. Okay. So revenue side is pretty small, 850 million to 1.4 billion in 2023. Big hits from COVID, but they are still they still have higher revenue than pre-COVID. Margins grow on the growth side have actually increased, and on the operating side have increased. So very impressive there. Return on invested capital outside of COVID year was almost always above 10% and recently as high as 20%. So very impressive there. Let's look at that balance sheet. 9 million cash on hand with 119 million in long-term debt. No short-term debt though. So not a lot of debt here, but not a lot of cash on hand either. Let's see. 119 million debt in relation to their 5-year average is very small, less than 2 years. So their 5-year average free cash flow, you're looking at probably about 100 million, and that is that is almost as much as their long-term debt. So not concerned with this balance sheet. Use of cash historically over the last 10 years, quite a bit of acquisition or a couple acquisitions. I shouldn't say quite a bit. A little bit on the acquisition side. They have been paying a dividend for quite a while, and then recently a bit of reinvestment and then share repurchases. And their share repurchases right now are definitely outpacing their stock-based compensation. But historically, it looks like there might have been some share issuance, really both on the both sides, issuing a little bit of shares and then issuing shares through stock-based compensation. But definitely buying back shares recently. The dividend payout, we're looking at probably about 40% right now. So nothing too concerning. All right, let's start making some assumptions here. I think this is going to be on the lighter side of the growth that we've seen from some of the other companies on this high ROIC screener. Maybe I'll do 5%. I'll do a slightly higher premium on the P and price to free cash flow in the market to just say like I think at the end of 7 years the growth will probably be in line with the market, maybe even a tad less, but the ability to reinvest at those high rates of return is kind of why I'm giving it still a slight premium. Margins have been elevated recently, but um, let's see, 7, 8. Let's do 7, 8. I think I'm good with that. And then share change, they've been buying back a bit recently, 1.7. You're looking at about 17, $18 million. They can double that. Let's do 1.5% share repurchases, 40% payout currently. They have increased that historically pretty consistently. So let's increase that in line with their revenue. And this will leave probably about 30 to 40% to reinvest back into themselves, make acquisitions that make sense, and then reduce debt. I think I'm comfortable with those assumptions there. So this gets us to a price that needs to fall 27% before we get a 15% return with these assumptions. Interesting company so far. So I do think that there's a lot of competition in this industry. I don't know if I've heard of many of these brands under the Lilly Pulitzer brand. I don't buy a lot of stuff like that, but Tommy Bahama, I don't know if I've heard of that either, but it looks like they do have a good business model going. Uh, but I'll definitely be doing more research once this gets to a slightly more attractive price. And yeah, I hope you enjoy the video. Have a great rest of your day. Thank you.